Welcome to The Explainer. Today, we're going to tear apart a sample investment portfolio, one that's been built specifically for the economic scene we might be looking at in 2026. This isn't just some list of stocks, it's really a strategic game plan for dealing with two massive forces, AI and inflation, which are pretty much set to define our near future. Okay, before we jump in, and I really have to stress this, please remember this is all for informational and educational purposes. We're just breaking down a sample strategy here. It is absolutely not a recommendation to buy or sell anything. So here's our game plan. First, we'll set the stage, the big picture economic stuff. Then we'll get our hands dirty and look at the sample portfolio itself. After that, we're going to decode the why behind it all, talk a little bit about risk, and then wrap it up with the key numbers. All right, let's get right to it. The entire idea behind this portfolio, the whole foundation, is built on the idea that 2026 is going to be this battleground between two huge competing economic forces. So, in one corner, you've got this incredible, almost unstoppable force of the AI supercycle, just driving insane amounts of growth and innovation. But in the other corner, pushing right back, you've got this stubborn, sticky inflation that's just hanging around at 3%. And with the Fed probably done cutting rates, well, you've got yourself a real economic tug of war. So how in the world do you build a portfolio for an environment like that, right? How do you try to catch all that upside without getting hammered by the downside? Let's take a look at one possible answer to that exact question. Wow, okay, so right off the bat, you can see this portfolio is not messing around. It's got a heavy concentration in a few key areas. You see MAGs, which is your big tech, and SPY, the S&P 500. Together, that's a huge chunk of the pie at 20 and 15%. But you can also see some other big slices in there before we even get to the full list. And here's the full breakdown. We're working with a hypothetical $100,000 portfolio here, and you can see all 10 tickers and how they're split up. It's a really interesting mix, isn't it? You've got your familiar tech and chip plays, but then you have these very specific bets on nuclear energy with NUKZ, cybersecurity with CIBR, and even an ETF called Moat, which tracks companies with those really strong competitive advantages. Okay, let's get to the fun part, the why behind all these picks. Because this isn't just a random list of hot stocks. No, it's a portfolio built on three core pillars, and each one is designed to tackle a piece of that 2026 economic puzzle we talked about. So what are those three pillars? First, it's about capturing the AI boom, but not by trying to pick the winning AI company, but by owning the stuff that powers it. Second, it's about building a real, deliberate defense against that sticky inflation. And third, it's about adding a little bit of juice, a measured amount of leverage to try and amplify the returns. This first pillar is honestly pretty clever. The thinking is that by 2026, the game is going to change. It's going to be less about who makes the single best AI model and way more about who provides the stuff you absolutely cannot do without. That means the chips, right? That's SOX. It means the massive amount of power AI needs. That's where nuclear energy comes in with NUKZ. And of course, the security to protect it all, CIBR. It's the classic picks and shovels play for the AI gold rush. All right, now for that inflation problem. To fight back in a world where your dollar might be losing its punch, this portfolio brings in assets like Bitcoin through the IBIT ETF and gold through UGL. The idea here isn't just to play defense. It's to own things that can potentially hold their value or maybe even grow when regular currency is feeling the pressure. And finally, let's talk leverage. Now, this is where things can get a little wild, right? But instead of going for those super high-risk 3x leveraged tech ETFs, this strategy is much more surgical. It uses QLD for a 2x exposure to the NASDAQ 100 and DPST, a 3x leveraged regional bank ETF, as more of a tactical bet. It's about adding a little horsepower, not strapping yourself to a rocket with no steering wheel. Okay, we absolutely have to talk about this. With any strategy that uses leverage and is so heavily concentrated in certain sectors, managing your risk is just as important as your initial picks, maybe even more important. This is not a set it and forget it kind of deal. And look, the source material doesn't pull any punches on this. It says it right here, loud and clear. This is an aggressive portfolio. Why? Because it's overweight and tech and it's using leverage. This is definitely not for the faint of heart. So what's the key to managing that risk? It's discipline. It's rebalancing every single quarter. See, those leveraged positions especially can get way out of whack because of all the volatility. So you have to regularly bring everything back into line. That's what keeps the strategy on track and stops one position from totally taking over your portfolio.
All right, let's bring it all home and look at the final numbers that really tell the story of this hypothetical $100,000 portfolio.
And this number right here, 1.2x, pretty much sums up the entire personality of this portfolio. When you factor in those leveraged ETFs, the whole thing carries about 1.2 times the market exposure of a regular portfolio. So yeah, it's been engineered to have a little more horsepower, but you have to remember that always comes with more risk. So we'll leave you with this final thought to chew on. If you kind of zoom out and look past the specific tickers like NUKZ and SOXX, what does a strategy like this really signal? It seems to be betting on a future where the crazy advancements in technology are completely and fundamentally tied to the massive and growing demand for the energy needed to power it all.